Thanks, Christina, for that very kind introduction, and welcome everybody to the event. Today I'm going to do something a little bit different from your usual commodities presentation. I want to provide a bit of context around the bull market in commodities, which is just steadily emerging. And I think most people here would remember the China-led bull market of the 2000s, but the one that's emerging at the moment I think is a little bit different, and it has sort of echoes of one of the great bull markets which happened in the 1970s. So first of all, I just want to sort of provide a little bit of context for the environment that we're in. You can see on the chart in front of you, which is the commodity price index divided by the S&P 500. We've had a great deal of capital flow away from commodities and so largely towards the big tech sector over the last 10 years or so. But all of a sudden, commodities have become a bottleneck to big tech's ambitions for data centre rollout and the energy generation. Sprinkled on top of that is a growing sort of level of geopolitical competition for commodities, and obviously there is the energy transition, which is very metal intensive, sprinkled on top of that. So there are certainly more. It's a little bit different to the last cycle we went through, and I think understanding the drivers of the bull market should hopefully help with your investment decisions. So my story today starts off in the late 1960s. The US was 10 years into their war with Vietnam, and they were slowly going broke. They were losing the war. It was costing them more and more money, and they had an inability able to fund that because at that point in time their currency was still pegged to the US dollar. The banks around the world saw the trouble that the United States was in, and they did what bankers do, and that is started to exploit this opportunity. So they were selling dollars back to the US government in return for gold at the peg price of $35 an ounce. And this was completely unsustainable. And you can see the US gold inventories on the right-hand side there were rapidly diminishing. And so eventually Nixon had to bite the bullet and do what had to be done and unpegged the US dollar from the price of gold, which enabled the US to basically print as much money as they want, and that happened in 1971. But this only solved half the problem. It's one thing to be able to issue as much debt and print as much money as you like, but you need a buyer for that debt. And the US needed a huge buyer for their debt, and no such buyer existed. And so this presented a problem for the United States. But in true United States fashion, they were very pragmatic and very creative in how they solved this, and they solved it by doing what the US does best, and that is starting a war. So just after the end of the gold standard, thanks to an exquisite bit of statecraft by Henry Kissinger, through which he misrepresented the positions of Israel, Egypt and Syria to each other, crystallised the Yom Kippur War in 1973. Now, I think the Israelis probably knew that the Egyptians were coming because the whole war was all over in 2 weeks, which is pretty benign by war standards. And you can see shortly after that, US deficits exploded. So they were successful in finding a new buyer. And let's just step through a bit of a timeline and sequence of events as to how that happened. So this is the important sequence of events plotted onto the oil price. The war kicked off in October of 73. Very shortly after that, OPEC raised oil prices in protest. I think probably at the suggestion of the United States, but the 70% initial increase wasn't enough. Iran, in a subsequent meeting, pushed for another 100% on top of that. And this came as a bit of a surprise to the OPEC members because much like OPEC often comments today, they're acutely aware of price-induced demand destruction. If you go and make the price of your product too expensive, people will go around and look for an alternative. And there is a bit of a hint as to what the driver of this decision was. And this came from a quote from Sheikh Yamani, who was the oil minister for Saudi Arabia at this time, in which he reiterated or recalled a conversation that he had with the Shah of Iran, in which he asked, why did Iran push for such a large increase in the OPEC oil price? To which the Shah replied, for the answer to your question, I suggest you go to Washington and ask Henry Kissinger. All of a sudden, the OPEC countries are flush with cash, and immediately, and despite, the United States being one of Israel's biggest allies, they've quickly did a deal with Saudi Arabia to, first of all, price oil only in US dollars, which helped preserve the US dollar as the global reserve currency, which they were worried about after undoing the gold peg, but also to invest the newfound wealth of Saudi Arabia and the other OPEC nations into US government debt. And as we saw from the previous slide, from this point onwards, government debt exploded. So the US had found their buyer. They were able to print their way out of the problem or the hole that they dug themselves into, but there was a threat to this plan that they'd enacted, and that came by way of the nuclear industry. So at this point in time, the nuclear industry was absolutely soaring. In 1974, the US connected one reactor per month to their grid. They were banging these things out quick smart. But the nuclear industry was starting to evolve and sort of go beyond stationary energy storage. But that aside, it is quite well documented that the US started lobbying against the rollout of the nuclear industry, particularly in Europe and particularly in the Middle East. And President Carter was very active in that cause. And there's a few suspicions that the United States was actually behind the Iranian Revolution, which then prevented the rollout of reactors in that country. But it wasn't just stationary storage that the US government was worried about. At this point in time, the nuclear industry was showing growing signs of moving away from stationary power generation towards mobile power generation. There were half a dozen companies, some very big ones, throwing money at nuclear-powered aircraft designs at this point in time. There were concepts for nuclear-powered trains, even nuclear-powered cars, which all might sound a little bit science fiction-y today, but keep in mind, like at this time in the 70s, you had the United States pushing out nuclear-powered subs, nuclear-powered boats. So mobile nuclear generation was certainly considered a possibility, and not just in actual generation, but nuclear-powered batteries were developed, and there's one of these each on the Voyager 1 and 2 satellites, which have been in space now for about 47 years, and they've still got about 20% of their original charge left. So what this slide, or this sequence of this slide represents, is a direct threat to the supremacy of oil as the fuel of the world, and that was unacceptable. So it wasn't just the US government lobbying against nuclear, it was the oil industry as well, and they were very happy to put their shoulder to the wheel to protect their market share. And they actually started doing this by funding green groups, which has a delicious touch of irony about it, starting with the seeding of the Friends of the Earth, which was started by a company known as Atlantic Refining. 200 grand got that lobby group up and running, and they've been very vocal anti-nuclear advocates ever since they were started. Ford you chipped in. They funded a very sort of seminal document called A Time to Choose: America's Energy Future, in which they acknowledged that nuclear was the key competitor to oil for the energy for energy supremacy going forward. And then the Ford company went on to seed the Natural Resources Defence Council, which has been anti-nuclear since day dot. And lastly, in more recent times, very well known, very old and well established environmental group, the Sierra Club, was happy to receive money from the gas industry from 2007 to 2010 to promote gas as an alternative to coal, but on the condition that they didn't entertain nuclear as part of this decarbonisation strategy. So unfortunately for the nuclear industry, when you're on the shit list of the US government and the oil and gas industry, which was all powerful back at this point in time, the battle for the hearts and minds is probably going to be lost. And that's exactly what happened. So, after going almost exponential in reactor starts, For no apparent reason, reactor starts rolled over hard from 1974. So that's a full half a decade before the 3 Mile Island incident, which was really, the Diet Coke of industrial accidents, really, to be frank. But beyond that, obviously we had Chernobyl in 1986, and I can't sugarcoat that. That was a legit disaster. But the straw that had broken the camel's back, nuclear reactor build-out had started, and the world remained very dependent on oil for the for the next 50 years. So that's sort of where it brings us to where we are today. And from that little anecdote, I want to there's three things that I really want to call out. So specific to the commodities that you're going to hear about, or the companies producing or looking for the commodities you're going to hear about later today. First of all, the US has very nearly gone broke before. It happened in 1933, just after the Great Depression. They reduced their peg to gold, and then I've already spoken about 1971. Fast forward to today, the US government is going broke again. I don't know how they're going to get out of it. I don't think there's anybody around that really does know how they're going to get out of it. But until their deficits show structural signs of improving, I think gold is going to continue to grind higher as a store of value, because the store of value of US dollars is somewhat open to question. The next point that I want to make is that the nuclear industry fell out of favour through no fault of its own. It had nothing to do with the technology. It was entirely to do with a lobbying effort designed to preserve the financing of the US government. And now, with a lot more money and more research being funneled back into the nuclear industry, I think you're going to start to see some of that, these fantastic developments from the 70s picked up, given a modern twist, and then over the years ahead get rolled out around the world. The last point I want to leave you with is that if a superpower wants commodity prices to go up, that's probably what's going to happen. And I think the United States has become acutely aware that their national security has been placed at risk by the inability to secure commodities or key commodities outside of the Chinese supply chain. And that throws back to the title of this presentation, is that commodities are a lot like oxygen. Nobody cares about them until you don't have any. And that realisation has dawned on the US government, and they've been quite clear that even though they started with rare earths, they're not done yet. They will continue to underwrite the prices of other key commodities over the years ahead. And whilst that works for your smaller commodities in terms of market size, like your rare earths, I think uranium might be next, but it's going to be a little bit different for things like copper, which has been doing remarkably well despite global demand being a little bit soggy. So on the left-hand side there, you've got a chart of the Purchasing Managers Index. This is a lead indicator for commodity demand, which you can see, like, relative to the last 20 years, is actually pretty soggy. It's just getting itself up off the mat post those sharply higher interest rates that we've just gone through. But the reason, or the driver of the copper price to get where it is today isn't really demand-led. It's more a supply story. And a big part of that is just this constant inability for the major copper miners around the world to make guidance. And you can see the downgrades that we've had so far this year on the left-hand side. When you have these big downgrades across a number of different companies, the market or the copper customers start to get more and more nervous. And then on top of that, you sprinkle a little bit of supply disruption, which we had a couple of weeks ago, where Tanzania had a few protests and their port had to shut. Through that port travels about 13% of the world's copper supply, coming from the DRC and also Zambia. So again, it makes people very nervous around where they're going to secure their copper from, and people start looking at copper inventories and whether or not they have enough. And on those inventories, it is fair to say they have increased a little bit over the last couple of years. There is an important trend on that chart on the left-hand side, and that is the movement of copper in Chinese warehouses to US warehouses. And that's happened because people are trying to anticipate the imposition of copper tariffs or import tariffs on further imports to the US, and that is a sign of the de-globalisation of the commodities market. If all of a sudden commodities aren't free to move around the world, that is inflationary. It will lead to higher prices, and obviously that's to the benefit of the consumers. So hopefully I've left you with a few thoughts there which might be of use. If you sit through today's presentation and you're still a little bit bamboozled by it all, I mean, another suggestion is to use a fund like ourselves. As Christine pointed out, we have sitting on an average of about 30% a year. So if you're, maybe you're confused by all the ideas you get thrown at you, this might be another one worth considering. But with that, I'll hand on to the next speaker. Thank you.